So today I'm going to talk about two stocks that I actually have sold recently. One of them was a bit of a trim just because it's been going a little bit crazy. The other one was a complete sell because the thesis that I had on this stock was broken and I thought there's no point having my money in this stock anymore. So I hope you enjoy the video. And also this is also me trying to be a bit transparent and making sure that I always talk about what I'm buying, what I'm selling. I'm not selling anything out in the background quietly. I'm not getting a stock that's not worked out and then going, okay, I'm never going to talk about that on the YouTube channel again and hope people forget about it. That's what a lot of the big YouTubers tend to do. So hope you enjoy the transparency. And if you do want to know what I'm buying selling in real time, make sure you join the Patreon. There's 2 exclusive videos a week on there. We'll be doing a live Q&A later. And also if you do want to get some free shares, sign up to Trading Tool 2. If you join through that link in the description, you could get a free share worth up to £100. But we'll get stuck onto these stocks today. So first of all, we'll talk about the one that I trimmed. So I did trim HIM's position by 5%. Now, before everyone gets carried away like, whoa, what are you doing? It was only 5% of my position. The rest of the position that I hold, I will carry on holding for a very long time. And as you guys know, I will be holding that for many, many years. But I thought this was the right time to just take a little bit of a profit off the table from HIMS. I think it was somewhere between a 65 to 70% gain that I took on this stock, which is absolutely amazing. And the reason why I trimmed the position slightly is because this stock's gone crazy. There's no doubt about it. The stock is up over 100% in the last year. And you compare that to the return on the market return in the last year is like down 5%. So this stock has outperformed the market massively. So with the stock going a little bit crazy, I thought, okay, it's time to just take a little bit of profit off the table with the momentum that we've had. I still think HIMS is a relatively good valuation, but I just see when there's big massive jumps in the stock, as my always quote that I go by is, be greedy when others are fearful and be fearful when others are greedy. And right now, it looks like people are getting a little bit greedy. So for me, I just want to take some profit off the table. And the other thing I've got to consider is, what if we drop in the market 10% right now? Imagine if the S&P has a drop of, let's say, 10%. If the market drops 10%, what's going to happen to HIMS stock? This over 100% return that it has, when the markets go up, this stock will outperform the markets, as we've just seen. But let's say there's a drop in the market, let's say, for reasons that we couldn't predict. Let's say China go invade Taiwan. Let's say that Russia do something. Let's say inflation ends up being a lot higher than what we were expecting, or the Fed actually increase interest rates quicker than what we thought, or more than what we thought. The market could maybe freak out and drop 10%. If that was to happen, what would happen to that return on HIMS? Well, that 120% return would massively reduce, probably down to like 60, 50%. And then I'd be looking, go, well, why didn't I take a little bit of profit? And at the end of the day, we're all here to make money. We're all here to make money in the stock market. And that's what I did. I wanted to make some money in the stock market. So I just sold some position for that point of view. And also look at Card Factory. Sometimes stocks drop for crazy reasons. I was invested in Card Factory, I think in 2020. From 2020, the stock into 2021 went up over 100%. I thought, excellent, sold some of my position in Card Factory. For no reason, Card Factory in 2021 to 2022, the stock went down. Nothing fundamentally went wrong with the business. Nothing changed with the business. It went from 100% gain back down to break even for no reason. And that can happen in the stock market. The stock market does crazy things. You need to be prepared for that. But the thing is that in 2021, I sold some of my position in Card Factory. So even though it went up and then it went back down again, there was a few people frustrated going, oh, I was up 100% and now it's back down again and I was up so much and I didn't take any profit off the table. For me, I was like looking at that going, well, I took some profit off the table. It's back down at good prices. The profit that I took off the table, I can put back into Card Factory now at better value. And now what's happening again? The stock's back up 100%. So that's how it can also work out. And the other thing is, you've got to protect some profits. I mean, look at Boohoo, for example. For me, I had Boohoo in 2020. Sold it out for 100% gain, bought back in, the stock went up once again. I was selling at 50% up, 60% up, 7% up, and then the stock's now gone back down again. Now for me, obviously there's a few things that affected Boohoo in that time frame, but for me, I've made plenty of good money off Boohoo, and now the stock's down. I'm not frustrated going, oh, it's done nothing in my portfolio. I've had money committed in this portfolio in Boohoo for 3 years now and it's not done anything for me. I could look and go, yeah, it's having a few problems at the moment. Yeah, it's down. But I can look at Boohoo and go, you made me good money though over the last few years. And that's because when there was greed out there, I maximised the potential on the greed. And then once again, I can then maximise the potential on fear. And that's even as a long-term investor, I feel like you've got to have that little bit thing about you of that it's always good to take a bit of profit off the table, because that's why we're here. We're here to make money, so take some money off the table. And that's what happened with HIMS. So now that I've took a little bit of money off the table, if HIMS was able to have a pullback, I can buy it. If the stock goes on a crazy run, as I think it will do, I've still got plenty of holding in there to do really well. So that's the reason for just trimming that HIMS position and taking a nice profit on that one. And the stock that I sold completely was a stock called TTCF, Tattooed Chef. Now, unfortunately, this is at the time, was one of two stocks that I was looking at and thinking, I don't think it's going to work out for this business. The thesis is broken, and I am worried that this stock will probably not make it to the end of the year. And I thought I better sell off this position and put that capital into some other stocks now. And I think it's a good point now to look at this stock and go, this is a learning opportunity. This is a stock that hasn't worked out for me. So where did this go wrong? So first of all, why did I buy TTCF? What was the reason behind Tattooed Chef? Well, when I bought it, as you probably will do, you probably thought, oh, it's a good opportunity. Everything looks to be going really well. And when you look back on it, I still think when I look at why I bought the stock was positive reasons. You look at what the potential was for this stock, and first of all, the company was profitable. You know, this company was a company that was making profit. And you're thinking, well, if you have a company that's making profit, it's not that much of a risky stock, or if it's near break even, you don't have to really worry about cash burn or the balance sheet. You look at the story, what was the potential? Well, they're a profitable private label company. They're now going to operate or sell a brand called Tattooed Chef. That's going to have better gross margins. They're already profitable. You introduce a premium brand. The premium brand is then going to have better gross margins. The profit goes up, and also you're going to have your revenue grow up. So that's the story. The brand offers growth and margin potential, and you look at what was happening. The TTCF brand was selling massive. The growth was massive. You had major clients coming on like Target saying it's the best frozen food product that they've ever had, and you're thinking, you know, this is doing really well. You know, you must have a good product if you're selling this much. You got companies like Target having more and more stores, offering more, in the stores, more SKUs, saying the good things like this. You can see why the story looked actually really good, and from a financial point of view, it looked really good. Now, when did the crack start? Because clearly you can see here the stock and the business was doing really well, and it was actually reflected on the share price. Even if you could say that we were in a very greedy market, the company was still doing well on a share price point of view. You know, I was up over 50%, I think, on this stock at one point. So where did it go wrong? Well, obviously the market obviously took a downturn, and the economy took a downturn. Those are sometimes hard things to predict, that you're going to have an economy that downturns and a market that downturns. Also, you had the whole CV situation that messed spending up quite a bit. You also had the slowdown in the category that it was in, which never helped. So them factors are quite hard to predict, and that also caused a few pressures on the company. But they weren't the main issues, but that obviously was a combination of factors that you can't really predict that sometimes happen. The other thing was financially inside the business, there was mistakes that had been made, and there was missing targets. So if you looked at the company, they were starting to miss EPS, margins were getting thinner and thinner, revenue targets were getting pulled back a little bit, and you're thinking, well, it was very positive before, and now they're starting to say about missing targets, margins being hit, financials not being where you want them to be. That's a key sign when that starts happening. The next thing is growth starts slowing. Now, if you're a growth stock, you need to have growth, and it was clear that as the quarters were going on, and I think there was even at one point where I think I said on a YouTube video, like, you look at the long-term target for the end of the year and you're adding up the growth, and you're like, well, if they're going to hit that long-term target they had in place, there's no way they're getting there, because they would have to do this much in Q3, they have to do this much in Q4, they're going to have to cut the guidance. And then what happened, probably I think it was in the next quarter, they end up cutting guidance. It's like, I predicted that, and I should have reacted off that. Next thing was some strange things in a public company that you wouldn't normally see. Gifting shares. You wouldn't normally have a CEO that is gifting shares inside a company. Missing quarters. So there would be times, I think there was one time where they were supposed to report earnings, and an hour before they went, oh, we haven't got the numbers in place, so we can't report earnings. And it's like, how have you not noticed that? You know, you're a publicly run company. You should have in place your financials. And if you haven't, you should let the market know at least an hour before. Or if we're getting an hour before reporting earnings and then you notice a mistake in your financials, that's not a really good sign for a public company to be doing mistakes like that. The CFO leaving. Now, the CFO suddenly left, and with all these other issues going on, it's a combination of like, is he clearly seeing something he doesn't like? That was another issue that added into it. And there was plenty of other things that were going on inside the company that I could have added onto this list, but it kind of shows you there was a combination of factors going on in this company that was not right. Now, the thing is that I saw all these things happening and it was making me worry as a shareholder. Now, this is where I made a mistake at Tattoo Chef, and this is where I went wrong with the business. I then went on and sold 30% of my Tattoo Chef shares for a small profit. So I got out with a little bit of a profit in Tattoo Chef for them, that 30% that I sold. And that was me taking some risk off the table, going, I don't like what's going on in this business. I'm going to protect my capital. I'm not happy with what management's doing. My mistake here, and what could have avoided me taking a loss on this company, is that rather than stepping away and only selling 30%, if I'm getting worried about a combination of these factors that are going on here, I shouldn't have sold 30% of my position. I should have sold all of it. And if I sold all of my position, I would have got away from making this error. And that was my mistake, and that's my learning that I'm sharing with you today. And what I'm taking away from this company here is that if there's ever a point where you start going, I don't like what's going on here, I don't like the margins are shrinking, I don't like them missing the targets, I don't like what the CFO leaving, I don't like them gifting shares, I don't like them missing the dates they should be reporting their earnings. If you have that combination of factors where you start losing the trust in the business, walk away. Walk away and sell it all. Don't do what I do and sell 30% and then still have to take the pain with the other 70%. That's where I personally made the mistake of investing into this business. When the investment was broke and I didn't trust it anymore, I only walked away a little bit, and I should have done it all. So that kind of leaves me overall is that trust your gut. If you have a bad feeling about a business, if you don't have that confidence in the business, walk away from it. And I should have walked away a little bit quicker. And the other thing is, you know, there's thousands, I've put 5,000 here, there's even more than that. There's plenty of stocks out there. You know, don't buy the company that you kind of have. If you're 80% sure on a business, don't buy it. Because you've got thousands of companies out there. Buy the ones that you're 99.9% sure on, and that will make you more confident to hold that, that position. And from this, really, I take away that now, anything that I see with management team that I'm not happy about, I question it. And if I still feel unhappy about that, then I walk away from it. And that's at least a learning curve that I took away from this one. An example for that is right now I'm up on a business called Celsius. So I'm up about 60% on that position. Now I've actually been selling off slowly my Celsius position. The reason why I've been selling that one off recently is because management, one of the key theories or thesis that I had on Celsius was that they execute on the US, which they're doing, but then they could execute in the UK and Europe. Now recently in the last quarters, I think it was 3 quarters ago, they stopped selling their products in the UK and in Europe, and the sales have been slowing down. And I've actually asked management, can you give me a reason why that's been happening? They've not been responding to my email. So I've gone, right, if you're not telling me what's going on and I've got a bad feeling about this, I'm going to start moving my position out. Now, I haven't sold it all, which I did say here, sell it all. The reason why is because with that one, they have had a major shareholder in Pepsi, and I feel like there potentially could be something going on at the moment with them and Pepsi about a mass EU launch. Now, that's my feeling, and I'm trusting my gut once again, that's what will potentially happen. However, because management aren't giving me the clarity there, that's me just using this experience now to go, okay, I'm not happy about that, I'm going to take some profit off the table. So that's something that kind of shows you that I'm already implementing into my investing at the moment. Now, overall, lucky for me, when you're investing, and I think it's Peter Lynch, which is obviously my favourite investor, he says that, you are going to get some stocks wrong. If you get 6 out of 10, I think the quote is something like, I'll probably put it on the screen for you guys. if you get 6 out of 10, you're a good investor if you get 6 out of 10 stocks right. No one's going to get 10 out of 10 stocks right. And, you've always got to remember there is going to be some times where you're going to get some investments wrong. That's part of the game. But lucky for me, and there's probably a YouTuber here out there at the moment that you can think of that will have this happen to them. For me, Tattoo Chef was only a small position, around 3-4%. I think at the most it was 4%. And then obviously when we take some profit off the table, it protected it a little bit. But for me, it wasn't a big position. If TTCF was all of this on my portfolio, half of the portfolio, this would have been a massive error. That would have been my wealth totally squeezed. And that would have been a massive mistake that would have took me years to get that wealth back. But because it was only a small position, lucky for me, it's not that much of an impact. Because with it being a 3 or 4% position, if HIMS is around about a 3 or 4 position, 3-4% position, then all I need to do is HIMS is to go up the percentage that I lost on Tattoo Chef, and that makes up the error. And that's why you want a diverse portfolio, because if you only have this go wrong, you can have all these positions here that can make up that error that you've just made. And that's the key thing why it's good to have positions that you sometimes trim, because they can sometimes make up for the ones that you haven't done so well on. And that's why it's so key to have diverse portfolio, because even though that's even a 3% position it stings. Lucky enough, there's other stocks that can make up that error that you make, and that was a lucky thing for me, is that I actually kept a very good portfolio size, and I was able to make up for that mistake by other stocks. And that's what's really key, and that's why, as long as it's a small position, all your other positions can make up for that error that you do make, and that's why diversification is key. And that's also why it's key to have some stocks that, if you can, let's say for example a stock like HIMS, if HIMS comes a 5-bagger for me, which I think it will do, I think it potentially could be a little bit more than that. If HIMS comes a 5-bagger for me, that is a stock that can easily make up for any mistakes that you make in the market. And remember, stocks go up more than 100%. You buy a stock can go down 100%, but a stock, if you're a bull, a stock can go up more than 100%. That can make up 200, 300, 400%. The returns are unlimited on the bull side of it. So that's why it's important to have a stock like HIMS, for example, that if that turns into a 5-bagger, for example, that's how you outperform the market, because a stock doing that makes up for any sort of mistakes that you make, but also then drives the returns as well. And that's how a lot of people outperform the market. That's when you look at a lot of the greatest investors like Peter Lynch, for example. The way that Peter Lynch outperforms the portfolio is by having a lot of stocks, but as long as he's got that one stock that really outperforms the market, that is what really lifts your gains up. So yeah, overall, there's a few points I wanted to put in this video today. Obviously, protecting profit, looking at mistakes and stocks that haven't worked out, and also the key about diversification and how diversification really does protect you as an investor, and also how having stocks that do very well can help you make up for them mistakes, and also how important it is to have a stock that really outperforms and that also makes up for any mistakes that you have or had, and also helps lift your portfolio so you outperform the market. So hope you enjoyed the video anyway, guys. A lot of transparency going on today, so if you could hit the like button, that's absolutely amazing. And join us on the Patreon later for the live stream if you're a Patreon member, and I'll catch you in a bit.